Hello class, welcome to Chapter 2. In Chapter 2, we'll cover financial markets and institutions. Okay, in this chapter we'll cover the importance of financial markets and institutions, the flow of savings to corporations, which is very important, functions of financial markets and intermediaries, and the crisis of the 2007 through 2009. Okay, let's turn to the importance of financial markets. Businesses and organizations have to go to the financial markets for financing they need. And the company's going to have to decide the source of funds, capital, or are they going to issue more stocks, or are they going to borrow the money? And of course, the money borrowing could be a business loan or issue bonds, and that comes with capital structure. We talked a little bit about this in Chapter 1. During your project here, one of the things that you're going to do is couple leverage ratios, and you want to find out how much debt a company has. One of the common leverage ratios is the debt equity ratio, which sees how much debt the company is using to support its business compared to how much stockholder equity is used to support the business. Like I said, you'll be using this ratio. Now, a company that has that's using more debt is going to be more risk. So a company is going to, like I said, decide the capital structure, see how they're going to receive their funds. And then the banks, or even when we talk about stocks, they're going to look at how much debt the company has. Of course, the more debt that a company has, the investor is going to, if they were going to purchase the company stock, is going to require a higher return. And the bank itself, or the bondholder, let's turn to the bank first. The bank is going to charge a higher interest rate, and an investor who's going to buy the bond would require a higher rate of return. So it's going to cost more money to finance for sources of funds for capital. Let's turn to an example here of the cost of paying a higher interest rate. I always like to use personal examples, even though we're talking about a corporation here, but for an individual, you have your scored credit or your credit score here, and a person who has a higher level of credit or scored credit, a higher number, such as, let's say they're between 760 and 850, they're going to get a better interest rate. In this particular instance, we're looking at two different people here, and one with a credit score of 760, which is considered excellent, and a person with a credit score 660. So as I stated in the last slide there, you're going to a lender is going to do a ratio analysis, and part of that is the leverage ratios. And like I said, they're going to charge a higher interest rate here. So a person with a higher credit score here is going to receive a better interest rate here. So you can see this particular person received 9.9. Karen, who has a lower credit score, is 19.90. And you can see the penalty or the cost of having a lower credit score is $40,000. That's a lot of money, especially for an individual. So just try to look at a company's perspective, that if they could get a 9 point, only pay 9.9, whereas having a higher debt level, they're going to have to pay 19.9. That could be a huge penalty for a company. Okay, let's turn to a simple flow of savings to a corporation. This example is using a small or closely held corporation. Of course, the investor, they invest in the company and they're going to receive stock. Of course, the cash raised from the shares issued goes to the corporation, and the corporation invests in real assets. Now, this particular illustration, it shows the returns from those investments or operations are being reinvested back into the company, which is usually what happens with a small and especially a startup company. There's a second option. They could give some of that money back to the investor, which would be a dividend. Now, usually your startup or your growth companies, it's a better situation for them to reinvest earnings back into the company. That way they don't have to invest or pay interest or issue new stock. Now, a benefit for the investor is they're hoping growth, That's why you'll see mutual funds called growth stocks. These are companies that reinvest in there, and how the investor is going to receive money there would be, of course, the stock value going up, which would be a capital gains if the individual stockholder would sell the stock. Okay, now let's look at a large public company, most likely listed on the stock exchange. Of course, they would have, I think, receive money from investors worldwide, same as the small closely held companies. But there's two different areas that they can also attain money through: financial markets, that's the stock market. Of course, the fixed income markets would be like bonds, and your money markets. You have financial institutions. Of course, there's bank and insurance companies. When you pay your premiums for your life insurance, they're going to take part of that to pay for operations, and of course, anyone that would die, and the rest of it's going to be invested. Of course, you have financial intermediaries. So if you purchase and put money into a mutual fund, which most of you probably have in your 403b, 401k, or just a regular non-qualified plan, or a pension program, those 403bs, 401ks are going in that, and that money can be directed as an investment, and the corporation will take that, just like the other illustration with the small company, invest in real assets, and then again they can reinvest it back into the company. Now, companies that have been around and aren't growing, such as a small startup company, probably would give some of that back to the investors in the form of a dividend. Of course, that's not a requirement or not guaranteed, but most, especially with your higher level companies like Ford, Apple, your banks, your utilities companies, the investor would expect some type of dividend coming back to them. Okay, let's continue on the discussion, and let's turn to the stock market here. Money can be raised by issuing new stocks. That's where the primary market is. You've heard of IPOs, initial public offerings, right there, or the company, if they already have stock out there, issue new stock. This is money that can be used for any purposes, new projects that a corporation may have. Benefit of issuing stock is they don't have to repay back anything. They also don't have to pay a dividend. But what they're losing is the more stock that's out there, that dilutes the values for current stockholders. So that could have an impact on the stock price. Now, of course, the second, to me, as I introduced myself, I was a stockbroker, and to me, the secondary markets, this is what makes stock investments possible. If I bought stock from a corporation, I had to find the buyer. I might not be willing to do that. Whereas with the secondary market, this is what makes stocks liquid, in the sense that you have the secondary market. So if I own Ford stock, I could own it for 5 minutes and sell it within the 5-minute period, or I could keep it for 5 years and sell it. So secondary markets are very important. It's a place for liquidity for stocks, and it makes it that people and companies also, that they purchase other company stock, make it a way to be able to invest that in a liquid form, in the sense that I can get out of it if I need the cash for other purposes. And here's just another slide of what I just said on the other slide here: financial markets, where securities are issued and traded. The primary market, most people don't deal with the primary markets, though. You hear about all these IPOs. It's hard to be able to buy IPOs. Also, you must remember there's a lot of risk, especially with startup companies. We all like to hear about Apple, Microsoft, companies like that went up, drew worth a lot of money, but there's many more losers. So there's a lot more risk involved with IPOs. Now, if it's a company that's been around and they issue more stock, then that's going to bring less risk to it. And of course, I've already talked about the secondary markets. If we didn't have the secondary markets, probably wouldn't have a lot of people investing in stocks. Okay, let's turn to the flow again of savings to corporations. You have your fixed income markets. These are marketed for debt securities. These would be like bonds. We're going to cover bonds in more details, but just to give you a little preview here, I mean, you have hybrid type bonds that can convert into stock itself. You have zero coupon bonds, all kinds of different types of bonds. And like I said, we're going to cover, in fact, you're going to have 2 discussion questions when we talk about bonds. Again, bonds are debt, and a company would have to decide, again, how much debt they're going to take on. Let's see here. You have your capital markets here, marketing for long-term financing, and you got to decide here money markets, money for short-term less than 1 year. Now I want to talk about here, if you notice here with when we talk about money markets, if you buy a money market fund, is paying next to nothing. As you notice here, the more liquid the fund is, in the sense of not losing capital or the value of it, the less interest you're going to get. So it's going to cost a company a lot less money to receive financing on a money market, in the sense that it's going to have a low interest rate. But then again, compared to a bond up here, most bonds are for 30 years. Now, I didn't mention this when I did talk about bonds. There is also the secondary market for bonds. So let's say you bought a 30-year bond. You don't have to keep it for the 30 years, but there's a secondary market on the over-the-counter market to sell your bonds. So there's liquidity in that sense. Let's look at some other chapters here. In this chapter, he talks about now foreign exchange markets. We're not going to talk about any of these in this course here. This is just an intro to corporate finance. But if you take more finance courses like Corporate Finance 505 or Investments 560, it's going to cover these. So you have foreign exchange markets, commodity markets, which would be chapter 24, and markets of options and derivatives, 23 and 24. Like I said, if you have an interest in these, then you'd want to take MBA 505 and MBA 560. Those are 2 other finance advanced courses. Okay, let's turn back to financial intermediaries. These are organizations that raise money from investors and provides financing for individual companies or others. I gave 2 examples. One would be like life insurance or insurance companies in general. They're going to take your the premium that you pay. Some of that's going to go to either help pay for death benefits if it's life insurance, if it's auto insurance, help pay for claims, whatever's left over after costs, they're going to invest that. So this is a major way for companies to receive money to grow with. Then there's also, which goes down there with financial institutions, you also have banks. They do the same thing. They take your deposit and loan it out to people. Also mutual funds. A lot of you guys probably have mutual funds. Benefit of mutual funds is you can take the expertise of a portfolio manager, usually a CFA, that's going to take your money and invest it. Probably one of the main benefits of going with a mutual fund, and we'll talk about mutual funds later in this course and any future finance courses that you take, that you have diversity there in sense that you don't invest all your money in one investment, such as, let's say you just buy Ford. You could have it in, there's some mutual funds in there have over 700 companies. So you have diversification, and that's very important. Also, with mutual fund, probably benefit is also the liquidity sense, in the sense that you can get in it today and you can sell it tomorrow, which you probably wouldn't want to do, but there's the liquidity side when we're talking about mutual funds. And here's an example: an investor investing into the Explorer Fund, and they could loan that money to Bank of America, and Bank of America sells shares, which will become part of this fund, and then the investor would have a part ownership of that fund based on how much they purchase into that mutual fund. So their capital gain or their dividends will be based on how much they owe that particular mutual fund. Like I said, the advantage of this is diversification.